Welcome back to Investing Talk Podcast.
Today we're looking at Hycroft Mining.
As usual, before we start, subscribe, like, and comment to this video to support the show.
Because today we are talking about a situation that is honestly just staggering.
Yeah, it really is.
We are looking at a company that just announced a massive, a 55% explosion in their measured and indicated resources.
Which is huge.
To put some hard numbers on that, we're looking at 16.4 million ounces of gold.
Right.
And 562.6 million ounces of silver.
Let's just pause right there, because if you're listening to this on your commute, those numbers might just sound like, large abstract figures.
They do, yeah.
Let's ground this. When you sit down and actually do the math at current commodity prices, we're talking about roughly $50 billion worth of precious metals.
50 billion.
$50 billion just sitting there locked in the Nevada dirt.
It's wild.
And the market has clearly noticed this data, because this realization has sparked an absolutely ridiculous 1,300% stock run from its previous lows.
Which is, a 1,300% run is the kind of parabolic move you usually only expect from an obscure tech startup.
Or some wild speculative play.
Exactly. Not a heavy industry company dealing with excavators and physical dirt.
Well, as the resident skeptic, I have to ask the obvious question here.
Go for it.
Having $50 billion sitting in the ground is a phenomenal headline, but can they actually get it out of the ground without going bankrupt first?
That is the ultimate tension driving this entire story.
Because pulling metal out of solid rock is not cheap.
Yeah, not at all.
And it's certainly not easy. It requires an astronomical amount of upfront capital.
It's a classic mining paradox. You have an asset base that rivals some of the biggest deposits in the region, but you have to bridge the massive gap between knowing the gold is there and actually putting a refined bar of it on a truck.
Right.
The sheer scale of the 55% resource upgrade is what's driving this immense enthusiasm. But the operational reality, the logistics of moving millions of tons of earth, is a massive mountain they still have to climb.
Before we get too deep, we should probably clarify a term you just used.
Which one?
Measured and indicated resources.
Oh, right.
For those of us who don't spend our weekends analyzing geological surveys, what separates that from, say, proven resources? Why should you care about those specific words?
That is a crucial distinction for anyone looking at mining stocks. Proven means you know the metal is there and you've completed the granular engineering to prove you can economically mine it right now.
Okay.
Measured and indicated means the drilling data tells us with a very high degree of confidence that the metal is in the ground.
But they haven't figured out the exact cost to extract it.
Exactly. The company hasn't done the final exact engineering to say precisely how much it will cost to pull every single ounce out. It is the crucial stepping stone right before a bank hands you a $1 billion loan to build the actual mine.
Which brings us to the difference between potential energy and kinetic energy.
Yeah, that's a good way to put it.
Right now, this entire $50 billion valuation is all potential energy. And frankly, the hype train is moving so fast that it's easy for an investor to lose sight of the actual financial mechanics of the business.
We need to look under the hood.
Let's pivot to the fundamentals to see if the math actually adds up.
Analyzing the baseline financials is the best way to cut through the hype.
Looking through the fiscal year 2024 numbers, my immediate reaction is just yikes.
It's a tough read.
The balance sheet is, to put it mildly, brutal. We are talking about literally zero revenue.
Yep.
Not low revenue, zero.
Because they have been in a pure exploration phase.
Right, and you obviously can't sell what you haven't dug up yet. That lack of revenue trickles all the way down the income statement. They posted a net income of negative $60.9 million.
Ouch.
Their diluted earnings per share was negative $2.63, and their EBITDA, which for a pre-revenue company is basically a metric of how much cash they are lighting on fire before the accountants get involved, was negative $41.6 million.
The cash burn is heavy. The initial runway numbers paint a very tight picture.
It is a bleeding patient.
Yeah.
Let's talk about that initial cash runway. Going into this, they only had $49.6 million in cash, but they were sitting on $124.9 million in long-term debt.
Which is an incredibly stressful position for management.
If you are burning $35.9 million a year on operating costs and your free cash flow sitting at a negative $37.1 million, well, you don't need to be a Wall Street analyst to see that the math gets scary.
It does.
They aren't just burning cash. They've essentially built a bonfire out in the Nevada desert. At that rate, they had roughly a 17-month runway before hitting a brick wall.
But let me offer the growth counterpunch here.
Okay.
Because the narrative has shifted dramatically since those 2024 figures. If we look at the third quarter of 2025, the net income improved to negative $9.4 million.
That represents a 20.1% sequential increase.
Exactly. It shows management tightening the ship as they pivot toward actual production. But the ultimate game changer, the catalyst that fundamentally alters their entire liquidity profile, is the recent capital raise.
The $235 million injection.
Yes, they successfully raised $235 million through equity offerings and private placements in the latest quarter.
That is a massive lifeline.
To put that into perspective, yes, they were operating with a negative shareholder equity of negative $33.4 million and a deeply concerning debt-to-equity ratio. But raising $250 million completely rewrites their timeline.
It essentially buys them survival.
More than that, it gives them the actual tangible cash they need to transition from just poking holes in the ground to scaling toward real production.
Taking that a step further, having cash is one thing, but they need an edge. They need a reason why their specific dirt is better than the dirt of the 100 other mining explorers out there.
Right.
So what does this all mean for their competitive advantage?
Their competitive moat is a combination of premier geography and exceptional geology. That expansive Nevada asset base is some of the best mining real estate on the planet.
Nevada is a top-tier, politically stable mining jurisdiction.
Exactly. And when you look at that 55% resource upgrade, again, jumping to 16.4 million ounces of gold and 562.6 million ounces of silver, it simply dwarfs the resource scale of their peers in the region.
Volume is great, but the quality of what they are pulling out of the ground is what really caught my eye.
The low-cost extraction potential tied to their geology is massive. A prime example is their Vortex silver system.
Let's talk about Vortex.
The initial high-grade silver findings there are off the charts. The reports highlight intercepts showing grades up to 1,545 grams per ton.
Let me jump in there. 1,545 grams per ton. Give me a baseline for that.
Sure.
If I'm looking at a standard profitable mine somewhere in North America, what's a normal grade? Because, the listener needs some context for how spectacular that number actually is.
A standard open-pit silver or gold mine might operate quite happily on 1 to 5 grams per ton.
Wow.
Sometimes even less if it is a massive, highly efficient operation. Hitting 1,545 grams per ton is like finding a vein of pure profit.
That's incredible.
Moving over to the charts and technicals, let's look at how the market is pricing in this Nevada dirt.
The technicals are fascinating because the volatility is just insane. If you look at the last year, the 52-week range is incredibly wide.
We are talking about a low of 2.22
Right.
and a staggering high of 58.73.
That is a massive pendulum swing for any portfolio to absorb. But what it indicates to technical traders is a clear pattern of higher highs.
We are seeing real breakout momentum here.
It isn't just a brief flash in the pan. It looks like a structural shift in how the stock trades.
The price action following the recourse update was particularly explosive. The stock didn't just drift higher on the news. Shares jumped 24% in a matter of days.
That is a violent, immediate repricing.
It reflects the market suddenly waking up to the implications of the independent technical report. And as we discussed earlier, this momentum extends that phenomenal 1,300% run from its previous lows.
What stands out to me is the volume supporting that structural shift. We are seeing very heavy volume driving this momentum.
Definitely.
During a highly volatile week, they were trading 1.18 million shares. And here is the kicker. They were hitting that volume even on down days.
Which tells us a lot about the psychology of the market right now.
Exactly.
When you see heavy volume on a red day for a stock like this, it means people aren't just selling the news and running for the exits when the price dips.
There is a strong appetite to accumulate shares even when the broader session is weak.
Absolutely.
Being a repeated top mover in the trading sessions implies a real psychological shift. It suggests that bullish control is firmly established above those key resistance levels,
The buyers are stepping in and holding the line.
refusing to let it drop back to its historical lows.
It also tells us that the $235 million capital raise wasn't just a lucky break. It reflects deep institutional interest.
For sure.
When you see volume consistently holding above 1 million shares in the sector, it's not just retail day traders flipping shares on their phones.
That is institutional money.
Hedge funds and asset managers repositioning themselves to gain exposure to this newly proven resource base.
Let's shift gears to market sentiment and see what the institutions are whispering.
Because clearly the narrative is driving the price action just as much as the actual drill results.
Oh, without a doubt.
The current market perception is predominantly overwhelmingly bullish. And it really all stems from the filing of their independent technical report on February 18th, 2026.
Right.
If you look at the top headlines driving the recent hype, they are incredibly direct. You have headlines screaming, Hycroft files independent technical report.
And the ones highlighting the actual growth numbers.
Exactly. Hycroft Mining stock surges after reporting 55% growth. It is a very clean, very powerful narrative. They proved the resources exist, and the market is rewarding them for it.
As the skeptic, I have to pull the one glaring bearish note from the headlines we reviewed.
There's always one.
There was a very prominent analyst piece titled, Up 1,300% since my sell call, why I'm still bearish.
I honestly love that.
It's great, right?
Uh,
Because it reminds you that some analysts refuse to take the bait, even when a stock goes parabolic. It is a stark reminder to you listening at home that despite the massive gains, there are seasoned professionals out there looking at this operation and saying, no, the risk profile is still too high for my taste.
It is entirely healthy to have that contrarian view in the ecosystem. But if we look at what people are actually doing with their money rather than just what analysts are writing, the insider flow tells a very compelling story.
The insider buying is fascinating.
There was a significant headline on February 25, 2026, titled, Going for Gold with Insiders, highlighting recent insider buying activity.
Which is a huge signal.
When you pair cluster buying from executives with a $235 million institutional equity raise, it paints a picture of extreme confidence from the people who know the company's internal operations best. Executives don't usually buy stock with their own money if they think the ship is sinking.
Here is where it gets really interesting, though. The speculative catalysts, the rumors.
The speculative side of this is adding serious fuel to the fire. Those high-grade vortex silver intercepts we talked about earlier.
The ones hitting 960 to 1,545 grams per ton.
Yes, they are opening up entirely new expansion targets. And whenever you have exceptionally high-grade discoveries sitting inside a massive, broader resource base, M&A speculation naturally follows.
Mergers and acquisitions.
Right. People across the industry start wondering if a major mining conglomerate is going to swoop in and just buy them out outright, rather than letting them build the mine themselves.
And this isn't happening in a vacuum. The macro tailwinds right now are fascinating. For instance, you have things like Zimbabwe's recent lithium export bans.
Right.
Now, if you are listening at home, you might be wondering what lithium in Africa has to do with gold and silver in Nevada. They are entirely different metals.
It is all about the tightening of global supply chains for critical minerals. When foreign countries start hoarding resources, nationalizing mines, or banning exports, it creates a ripple effect of panic across all commodity sectors.
It forces massive amounts of capital to rotate into safe, domestic hard assets.
Suddenly, a massive gold and silver deposit sitting safely in Nevada becomes incredibly attractive because there is zero geopolitical risk of the government seizing the asset.
Add to that the broader macroeconomic expectations of rate cuts.
That's a huge factor.
Traditionally, when rates get cut, it weakens the dollar, which in turn boosts of precious metals. You end up with a perfect storm rotating sector money directly into companies like this.
But you're the skeptic here. Let's unpack the risks. What is the actual bear case?
Well, no stock goes up 1,300% without carrying a massive amount of hidden danger.
Very true.
Let's go deep on the operational reality. We keep talking about this $50 billion sitting in the ground. I need to stress that pulling $50 billion out of the earth is an incredibly capital-intensive process.
It is.
You don't just show up with a shovel and a pickup truck. You need earth movers, massive industrial crushers, and heap leach pads.
Which are massively expensive to build.
And if you aren't familiar with a heap leach pad, it is essentially a massive, highly engineered, lined football field where you pile up crushed rock and spray it with chemical solutions to dissolve the gold out. It is a logistical and environmental permitting nightmare.
The execution risk is absolutely the elephant in the room.
And remember those fundamentals we talked about earlier? They're currently losing money. Their Q3 2025 net income was negative $9.4 million.
Right.
They are relying entirely on cash flow that simply does not exist yet from operations. But my biggest warning for anyone watching this is commodity price sensitivity.
Meaning a drop in gold prices.
Yeah, exactly. What happens if gold prices take a sudden dip? They just raised $235 million, which sounds like an infinite amount of money. But in the mining world, if the price of your end product drops by 10 or 15%, your operating margins evaporate instantly.
That's the reality of the
If gold dips, that $235 million runway will burn up significantly faster than expected. They could find themselves thrown right back into a liquidity crisis before they even reach full commercial production.
Those are entirely valid points. Building a mine from scratch is notorious for cost overruns and multi-year delays. However, I would argue that this specific execution risk is currently priced into their status as an early-stage producer.
How so?
The market isn't valuing them as a fully operational, mature mining giant yet. They are valuing the transition phase. And while a gold price dip would definitely hurt their margins, that massive $235 million capital raise severely de-risks the short-term panic.
It's a buffer.
It gives them a thick financial buffer to weather a potential storm that they simply didn't have a year ago.
All right, it's time for the final verdict.
We've looked at the massive 55% resource upgrades.
The brutal initial balance sheet.
That life-saving $250 million cash injection.
But wild technical charts.
And the very real execution risks.
So where do we land?
Based on the synthesis of all this data, the research yields a bullish score of 8 out of 10.
An 8 out of 10. Okay, give me the elevator pitch thesis. Why does it score so high?
The core thesis is that Hycroft Mining represents a high-reward pivot from exploration losses to active production. Yes, there are execution risks, but the 55% resource explosion completely changes the company's baseline value.
It's a paradigm shift.
Paired with that $235 million cash injection, they finally have the financial fuel they need to build the infrastructure. Add in the high-grade vortex discoveries acting as near-term upside catalysts, and the fact that they're positioned amid incredibly strong macroeconomic gold tailwinds.
It's a potent combination.
Ultimately, it is positioned for a multi-bagger re-rating as they execute this pivot from explorer to producer.
I tend to agree on the timeline for how this might play out. The target horizon here looks like a swing trade heading into their expected Q1 2026 earnings.
That's going to be a crucial quarter.
That is going to be the critical moment where the market demands to see actual tangible production progress, not just more drill results. But if they deliver on that, it pairs beautifully with multi-year hold potential as those macro tailwinds like the supply chain tightening we discussed continue to play out.
It really is a fascinating transition to watch unfold in real time.
It leaves you wondering, in an era where global supply chains are fracturing and resource nationalism is on the rise, how much of a premium are we going to start placing on gold and silver that is sitting safely in our own backyard?
That is a great question to leave on.
Think about what that means for domestic assets as you watch this stock over the next few months. If you want to stay ahead of these massive market moves, make sure to subscribe, like, and comment below. See you on the next one.